Hello, everyone, and happy Friday. Welcome to another edition of Let's Talk About It. Today, we're going to be talking about the dreaded R word, and that is recession and recession risk. We're joined today by Dennis Stearns, founder and president of Stearns Financial Group. Welcome, Dennis.
Good morning, thanks.
So I'm going to pull up a couple of slides that we can start to go through talking about recession risk. So let's see if I can figure this out. Here we go. The dreaded R word. I know that there's been a lot of talk and actually live debate in real time about are we or are we not in a recession? So I know you have some thoughts on that, Dennis. Talk to us about what you think.
Sure, and just a housekeeping note, if you are having trouble seeing this on whatever device you're on, you can go up to view options and make it larger on your own screen. So the recession talk has become pretty prevalent today, and the discussion about is a recession already underway? Are we going into one? A lot of it was triggered by the fact that we had a negative gross domestic product read in the first quarter of this year. And then we also had a negative gross domestic product number in the second quarter of this year. And so 2 quarters back to back is sort of the shorthand for recession, but it is not the official definition of recession. And so the National Bureau of Economic Research is the one that looks at a lot of other activities, and the unemployment trends, as we've highlighted here, is a key piece of that. And so with unemployment being low, meaning employment being very good and tight right now, the question is this an official recession? And then finally, the really interesting piece, this last paragraph, is that we mentioned this in our poolside chat a few editions ago, that the first quarter negative reading in GDP, it had inventory and supply chain quirks in it. And so a lot of economists have said, that didn't necessarily tell us anything anyway.
Yeah, so I think what we're saying is this time maybe is different because we had a once in a lifetime pandemic. We had a manufactured government shutdown, essentially, of the economy. So naturally, when you go from that place to now, everything seems inflationary, all the numbers are bigger, and it's hard to really make sense of the data points because of this artificial shutting down of the economy.
Yeah, absolutely. That's at work here. And so, yeah, this quote from Ian Shepherdson, who's a very good chief economist, really kind of sums it up well about the first quarter had to do with a lot of inventory, supply chain issues. And in his opinion, those things will adjust over the balance of 2022, and they'll actually boost GDP growth. Again, does that mean that we're growing faster? Not really. It just means that we've got anomalies in the data from quarter to quarter.
Yeah, so I think what this is saying is we just can't put too much credence in this right out of coming out of the pandemic economic data. That doesn't change the fact that we do have some slowing economic indicators, right?
Yeah, absolutely. There is slowing in the economy, and some of it a result of the Federal Reserve raising interest rates, and their intent is to create some drag in the economy that will slow things down, hopefully slow down demand coming out of the pandemic, and that'll help inflation. And again, the question is, do they drag it down too much and actually throw us into a recession to cure inflation?
Yeah, so looking at some of this data, obviously single housing, unit housing permits are down. As we all know, mortgage rates have doubled in the last 6 months, just due to Fed tightening. And so that's really no surprise. Again, it's the Fed. But we do have a lot of indicators here, 7 of 8, that indicate a recession checklist. But Dennis, as you've mentioned many times, several of these items have sort of reversed since this was out, right?
That's exactly right. And so it's, again, there's a lot of noise in the system right now. The University of Michigan consumer expectations, did it have a 10-point decline? Yes. Does it deserve to be on this checklist? Yes. However, the month of July, we just got the reading and it actually ticked back up. So a bit more positive. Initial jobless claim, same thing. You know, we had a rising 4-week trend, but then all of a sudden we just had a very good jobs report, better than anticipated.
Yeah.
And financial conditions down at the bottom, the reason it's highlighted in yellow is that Stratagas, who put this together, they talk about the fact that not all measures are strained. And so again, it's a very mixed bag of data going in different directions.
Yeah. So as we talked about, we can argue over, are we in a recession or are we not in a recession? Clearly, there's no question that economically we're slowing down. And I think this chart, which talks about, if you can see, the dark blue line is the money supply, and then the red line is the core CPI, that there does appear to be a pretty strong correlation between the two. And so now that the Fed is tightening here, we would expect, I mean, that's the whole point, right? To cool off inflation.
Yeah, you cool off inflation. And this also represents, with the money supply, some of that sugar high we had, if you will, from the stimulus programs that were going on during the pandemic, trying to make sure that cash was infused into the economy and to make sure that we didn't go into a more difficult economic environment. Well, that cash, as this shows, has been slowly worked off. And so, again, the classic definition of inflation is too much money chasing too few goods. And we now have a lot less money chasing, meaning inflation is likely to continue to come down some.
And we are starting to see some easing indicators of the supply chain, right? Some reshoring going on, different workarounds. Capitalism, as we know, is very agile.
Absolutely. Yeah, not a week goes by that we don't hear a dozen stories from companies, some we work with and some we are on analyst calls, talking about how things are getting better on the supply chain.
This one is super interesting for our audience. Gross domestic income versus gross domestic product. We don't hear a lot about gross domestic income, but that's basically exactly what it sounds like. Income from all sources. That includes wages, interest, dividends. It's sort of an indicator of consumer health versus the GDP. And so the correlation between the two, obviously they're highly correlated, but sometimes there's a gap. And I know in 2008, the GDI, which was the income number, was a lot worse than GDP. GDP would not have indicated the Great Recession as we ultimately came to see it, but GDI would have, right, Dennis?
That's right. It was the better predictor faster. Now GDP was revised a couple of times, and it always is in hindsight revised in 2008 and showed a oh my God moment for the economy, but GDI picked it up first.
Yeah, and so the hope now is, and I think the red line is the GDI. GDI is looking better right now than GDP. So, you know, the fixation on whether we're on a recession based solely on GDP maybe isn't the way to look at it. It's actually a combination of the two. For you wonks out there, the combination is called gross domestic output. But so far, the GDI, which historically has often been a better indicator, is looking better than GDP. So the hope is that if and when we enter a recession, if this is a good predictor, it won't be as deep or as long. So we're hopeful that it's a softer landing, in other words.
Yeah, that's exactly right. And the interesting thing is that the next GDI reading for the second quarter is due out next week. So by the time we send out our next poolside chat, we should have some indicators about what's happening there.
Fingers crossed, right?
Yeah, fingers crossed. I mean, again, chances are good that it's still positive. And the Council of Economic Advisors and a whole bunch of other entities have basically said, don't just use GDP. And yet that's all you hear from the talking heads on TV and elsewhere is GDP, because it's the most widely known of the economic indicators.
It's also a much more compelling news story. 2 negative quarters of GDP without all the nuance really catches the headlines, a lot of clicks, a lot of advertising dollars. So it's not a surprise, but it's a lot more nuanced than that.
Yep, absolutely.
So this next slide is super interesting. And it talks about unemployment, which, as we all know, is at record lows at 3.5%. It's really hard to imagine a true recession when you've got unemployment at the levels that they're at. But what this chart shows is, and the dark line that's squiggly is the unemployment rate. The red lines show, the red circles, I should say, show that every time that unemployment is the lowest it's been and starts trending up, it appears as though it keeps going up, and that correlates pretty strongly with recessions. These bar graphs are the recessions, so you can see a pretty big correlation between unemployment going up and then a recession correlating with that.
Yeah, the popular joke is that if my neighbor's lost his job, it's a recession, and if I've lost my job, it's a depression. And so the question is, will we see a lot of layoffs happening? We've seen a few announced, and will more happen in 2023? Right now, the PricewaterhouseCoopers survey just came out, and it says 50% of companies are expecting to do some layoffs, but 50% of companies are expected to do more hiring and are having trouble finding people. And there was an overlap of a bunch of companies that are expecting to try to be hiring while maybe laying off in certain areas. And so we're going to have to keep a very close eye on this. Is it possible to have a recession without this uptick in unemployment? Maybe. Again, sailing in uncharted waters, maybe we have a new definition of a recession here.
Yeah, but hopefully softer, because the higher employment we have, the more money there is for people to spend, right?
Well, that's right. And so again, we're a consumer-driven economy, and as long as consumers have money and have the confidence to spend it, then we'll keep humming along.
So let's take a look at these leading economic indicators coupled with the labor market. Tell us what this all means, Dennis.
Yeah, so this is the, in blue, the Conference Board's economic indicators, and we've outlined those in prior poolside chats, how they stack up. And so as you can see from the blue line, we've had a nice recovery. First of all, a good growth overall over this period from 1990, but a nice recovery from the bottom of the pandemic. But notice in the far right, we've got the little bit of the downtick. So there's the softening of the economy, and the non-farm payrolls, which is the orangish line, depending on your screen colors. That particular piece, again, if history is any guide, may start softening as well. But what you'll notice here is that even when we've had some pretty bad downticks in the blue line, the
Like
gold
here, for
line does not
example.
always follow them all the way down.
Yeah, so it's a lot smoother of a ride, it looks like, in terms of following what's going on with the economic indicators, with the
That's right.
exception being here, which was, let's call it a manufactured shutting down of the economy. So that's not exactly the same as a natural ticking down of the economy.
Yeah, and we've got the crazy factor right now of 2 job openings for every person to fill it. And so could that soften? Actually, that would possibly be good news if it didn't soften too much. And so that's the question is, does it soften enough to really put us in a more difficult recession in 2023?
Yeah, so we wouldn't mind seeing some softening just because of wage inflation right now, right? But obviously, if it goes down too far, that's not good for the economy.
That's right. And we have had a number of clients who have reported in their businesses, public or private, that they're getting some better flow of potential hires just in the last couple of months. But we've got other clients in businesses where the unemployment rate is so low within their industry that they're just struggling still. So
Yeah, and I think immigration has a lot to do with that number as well. So
yeah, in some cases, depending on the skill sets needed of the individuals.
yeah. So let's look at earnings growth versus recession expectations. I know we as Americans, in the news that you read, the US is faring a whole lot better than many other parts of the world post-pandemic. We've bounced back more quickly. Our inflation rate, high as they are, is lower than a lot of other countries, which is the exact reason why the growth expectations are bigger potentially in other countries. Talk to us about that, Dennis.
Yeah, so the really good news here for stocks is that earnings have continued to be strong. And there was a lot of worry 6 months ago about the rising labor costs, the inputs to the supply chain with all the inflation and how that could destroy profit margins. And it's had pressure, no question about it, a lot of headwinds. But again, companies have figured out workarounds in a lot of cases. And so, we've got some surprising forward-looking forecasts of earnings for the US. I mean, there was a worry back in June when the stock market swooned down. There was a lot of worries, and one of them was that earnings might go to zero for this year. Well, that hadn't been the case. We've had 75% of companies in the last reporting cycle, public companies, that reported at expectations or above for their reported earnings.
It's actually stock market resilience has been tremendous. Not saying there hasn't been volatility, but considering a once in a lifetime event of the pandemic, a manufactured or synthetic shutdown, all the spending, economic stimulus, all the things that have happened, and yet the stock market had record years last year even, right? And a lot of the volatility in the market this year is potentially due more to expected Federal Reserve actions and investor sentiment surrounding that than economic data potentially.
Yeah, absolutely. And, we are also tracking things like corporate tax increases that could create some issues for 2023 for some companies. But the new minimum tax that's in the new Inflation Reduction Act doesn't look like it's going to have a material impact on most companies. And so, again, I think, all of this suggests if we're going to have a recession, it'll probably be milder.
I know that that's good news for all of us, right? So,
Well, yeah, and I say
yeah.
that, and there are always sectors of the economy that take it on the chin more and have a tougher time. I mean, if you're in the mortgage business right now, you're seeing your business drop off significantly. So again, this is one of those that the national numbers can say one thing, but the very localized numbers can say something different. You know, I know a lot of our friends in the Raleigh-Durham, Chapel Hill area and in the Austin area. Those areas are just exploding. You know, it's not even clear if there was a recession, they would know it. So again, there's just a lot of factors of how someone's going to be impacted.
And so much of this is dependent on the nature of what happened in 2020. You know, we had the stay-at-home stocks doing really well during that period. Now, all of a sudden, we've moved away from that and more into the travel and leisure segment. So a lot of it is just psychological rebound from the pandemic in terms of what's doing well and what isn't.
Yep.
So let's look at how the recession risk potentially impacts various asset classes. By the way, we have most of these asset classes in most portfolios for Stern's clients. And so tell us what this diversified pool of assets might do in a recession, Dennis.
Sure. And so cash to start out with should have no impact other than the blip up in interest rates that we've had here of late that have pushed money market yields above 2%. Maybe they dip back below 2%. Bonds, really no impact as long as you're in high quality bonds, which we are. We have done some major retooling of our bond portfolios in the last few years. Now, prices of bonds may actually go up as interest rates go down, depending on, again, on is it a mild recession or is it something a little worse? US stocks, probably moderate impact due to the valuation reset that we've had the first 6 months of this year. And so, you know, again, the fact that valuations have gotten more reasonable, fair market range, suggests that the downside may not be as onerous as long as it's a mild recession. Now, again, there's just a lot of conflicting data. And by the way, we're not saying that June of this year was the absolute bottom. You know, these things, very bad bear markets often have a double dip bottom. So, you know, we may go back down and retest those lows, but it's a bit of a coin flip at this point, whether we will or won't. As we've always talked about, calling short-term moves in the stock market is a fool's errand because there is a lot of just emotions in that short-term piece. International stocks, again, moderate risk due to valuation reset. This surprises most people because a lot of people are more fearful of international stocks right now because of everything going on in Ukraine, possibility of things going on in Taiwan, and just the general possibility of Europe going into a major recession. And the fact is, a lot of those international stocks, number one, have been priced to reflect some of that. Number two, a lot of them have a third to a half of their sales back here in the United States. So many of these are big blue chip companies overseas are true multinationals around the globe, and their employment is around the globe. So they're less susceptible to what's happening in their own backyard. Income real estate, that one, we think the impact would be low due to demand and demographics, particularly the multifamily sector that we've done so well in for the last decade. And that area, you know, there's an estimated 4 to 6 years before supply of apartments and rental homes will catch up with demand. And we have more of the millennials who may have doubled up in renting a place during COVID, or maybe they were still living in their parents' basement, are now going out and renting apartments or renting a home. We have Gen Z coming out of college into a really good labor market, making pretty good money, they can't afford a home. So they generally have to rent. And so that demand and demographics piece, again, insulates some of that from a mild recession. Now, if it got really bad and unemployment went way, way up and people can't afford their rent, that's a whole nother kettle of fish. Again, the data doesn't suggest that right now, but it's going to be something we'll have to keep an eye on. Infrastructure, agriculture, timber, the joke around our firm is that toll roads and pistachio farms really don't care what Putin is doing, and they don't have as much susceptibility to economic cycles. So low expected risk in a recession there. Private credit, low, mainly because a lot of the private credit we're doing is with high quality companies. And right now, not seeing any danger points with those private companies. Private equity, again, low to moderate risk. Again, depending on the types of companies, and we have a lot of different managers in this area that are doing things from very niche-y to, big companies going public. So kind of a mixed bag there, but again, low to moderate risk in a recession. And venture capital, the same thing. Venture capital, in fact, is much more company specific because you've got these smaller companies. Some of them have great niches. And again, some of them may just power through a mild recession, wouldn't even notice that was happening because of the demand characteristics. But there's other companies that, could find themselves in a soft spot. So again, diversification within each one of these areas, more important than ever. Within the whole area, more important than ever, given the fog of uncertainty, the zone of uncertainty that rests around a lot of this that we're looking at right now.
Yeah, and I'm very happy to report that we're very well diversified in our portfolios. And as a result, we're in one of the few times in history where stocks and bonds are down about the same. I mean, that just doesn't happen. I think maybe it's happened 3 times before. And so fortunately, due to some of the private real estate, the infrastructure, agriculture, timber, some of the other areas that we have in the portfolios, very few of our clients have seen the full brunt of the market downturn. And so, we're very well diversified exactly for this reason. One never can predict which asset class is going to do what in the short term, as Dennis says. So being diversified is really the reason to be diversified, is because of that, right?
Right. And we try to strive to not be diversified, so diversified that we can't, make some decent returns in up years. So there's a balancing act to how much you diversify.
Yeah, that's right. And so I know from just anecdotally speaking to clients, and I know you do too, Dennis, that there's a lot of anxiety out there. People are nervous, whether you're watching Fox or MSNBC or CNBC or Bloomberg, or get your news from, Yahoo Finance. Everything that you look at is pretty negative. There's a lot of fear mongering in the media. And why, right? Because fear drives clicks and views, and it drives advertising dollars. It's really important to insulate yourself from all of that noise out there and focus on the few things that we actually can control. We can't control what's going to happen in Ukraine more than what our government is doing, right? Personally, what we can control is the actions that we take to secure our own financial well-being. And so to that end, we have a checklist of things that you can do, because it's easy to feel helpless in an environment like this. So one of the primary things, and something that we're known for, is our scenario planning, our financial planning. And so many of you clients already have financial plans. Those of you that don't, please understand that financial planning is an inclusive part of the fees that you pay. There's no additional cost. especially if you're considering retiring within the next, let's say, 1 to 3 years. Let's refresh that financial plan and make sure that we've got enough money on the sidelines, enough insurance kinds of things if you need them. Let's just look at it and make sure that you're going into retirement with your eyes wide open, taking a long view and avoiding knee-jerk reactions. I mean, Dennis, you've been doing this a long time. I'm sure you've seen clients panic, want to go to cash, and want to get back in the market when things are quote unquote better. That's effectively selling low and buying high, right? I mean, that's not the way that people make money in the stock market.
Yeah, if it were only so easy.
Yeah, so really just staying the course. Now, if you have trouble sleeping at night and you just can't shake that, please call us, call your advisor. Let us see if we can figure out a way to reduce some of the volatility in the market for you without going all the way. I'm always astounded when I talk to people. They're like, oh, I think I should go to cash. The market's crashing and you look at the portfolio and it's down, let's say it's down $500,000. It's almost a surprise when I say something like, you realize if we go to cash right now, you've just locked in that paper loss. That was a paper loss. Tomorrow the market could be back up, but the minute you sell, it's permanent. And so, just keep that in mind, that weathering the storm is really the way, and history has proven this out, to maintain your financial net worth and security is you have to stay the course in down markets. You just have to.
Yeah, and a lot of times they will call us, Holly, after they've been watching too much cable TV or reading internet stories. So, just for fun, recently I've been watching multiple shows and recording the number of times that something that would raise your blood pressure was said. And, Fox, CNN, CNBC in particular are guilty of this. Bloomberg, not so much. Bloomberg doesn't really get into some of the hyperbole. But I noticed on those other 3 shows, they are up to 10 items or more per minute that could raise your blood pressure. Now, again, it's on purpose because they are trying to get you riled up, get you watching their show more, getting you to come back to their show tomorrow, find out what happens. And so that is just a prescription for needing Valium or Prozac or something. So again, I double down on your avoid the media hype comment.
Yeah, and I'm skipping around here, but if you look at the last item, keeping it in perspective, it's easy if you're watching those shows and obsessing over it to feel like the world is falling apart, a country divided, on the brink of a civil war or a world war. Yeah, you could take that perspective, but if you look back historically at all the things our country has been through, we were pretty divided during Vietnam. We've survived assassinations of presidents. We've survived 2 world wars, the Holocaust. I mean, there have been many worse things than we're encountering right now. I mean, when looked at it in that context, we're actually not in a bad place. I mean, the market's down maybe 9%. The average market decline in any given year over the last 40 years, I think, has been 14%. So we're in the normal range right now. And it's true, things could get worse. We could be in a bear market rally, but all in all, things just ain't that bad, right? And so you don't turn on the news and hear that message, but I'm sure that all of us, it would be good for our mental health and our physical health to just kind of try to keep that in mind.
Yeah, I thought it was remarkable on many of the earnings calls just this week, major retailers, major companies in all kinds of areas. And the consistent message was the consumers who buy what we sell are generally in pretty darn good shape. I mean, I just heard that over and over and over again. And again, there's some other data we look at that's consistent with that. And so again, that suggests that, as you say, things aren't as bad as they appear.
Yeah, so with that said, we always want to be prudent, right? I mean, clearly we're in an economic slowdown right now. We don't know how bad it might get. Hopefully it's a soft landing, but maybe it could be worse for some time. It always makes sense to have cash reserves on the sideline, and particularly so right now. So having 1 or 2 years worth of living expenses, and the question is, well, why? Because unexpected things always come up. If the markets are down, stocks and bonds are down, we don't want to have to sell assets low to fund an emergency situation. So it makes good sense to keep some money on the sidelines. And that obviously applies to your businesses as well as to your individual lives. But remember too, that when markets are down, and I like to think of this as stocks are on sale, the only thing that goes on sale where instead of rushing to buy, people go in the other direction, right? So it's not a bad time to start a disciplined approach into the markets. That doesn't mean going all in, but if you're in your 40s and you're working and you're contributing to your 401k, please don't stop doing that. I mean, just continue to sock it away. And if you're older and you've had a windfall, let's say you've sold your company or sold let's say a second property at the sky high prices that we've seen recently, and you've got extra cash on the sideline, talk to your advisor about what you can do with that money at a time when stocks are somewhat on sale. And we also have a lot of different approaches to helping you keep more of what you just made in terms of tax savings. So we've got some tax loss harvesting strategies, other strategies that we can utilize to help you offset those gains and keep more of the money in-house, let's call it. Any other thoughts, Dennis? I mean, I'd just say the bottom line is that economic slowdowns are a normal part of a business cycle. We've had probably the longest bull market ever in history in recent times. And again, it slowed down because of a pandemic and a synthetic shutting down of the economy, right? And so that can't go on forever. We expect some volatility throughout the end of the year. But it's just not that bad at this point. So I think keeping it in perspective and focusing on your own financial security and well-being is the way to go.
I agree. And again, something that we've said many, many times over the years in our poolside chats and other publications is make yourself indispensable. If you're not already indispensable, and assuming you're working, whether it's your business or whether it's your career, make sure you're indispensable, and that creates a safety moat around you, the brand called you, that will make sure that if we do get into a more difficult time, that you don't find yourself unemployed. And we've talked about this relative to super trends, that this changing nature of jobs, which is just remarkable what's going on just with the jobs that are disappearing, the new job careers coming into play. That alone is a great reason to make yourself indispensable, to up your game, whether it's leadership skills, communication skills, or whatever the unique skills are of what you do.
That's right. We're our own economic engine. So we don't have to just move with the wind of the broader world. You can always create your own path. And again, call us, talk to your advisor if you would like some resources in that area.
Yeah, one of our clients who heads a company says he always makes the mistake to hire his executive coach when he's in a crisis, and he needs to think about it when he sees storm clouds ahead so that he can get ahead of the curve. So maybe that's also good advice for this environment that we're in right now.
Well, thank you all for tuning in, and thank you, Dennis, for your wisdom. You have a lot of experience, and I know you've seen a lot of ups and downs in the market. So until I hear you blow the whistle, I'm not going to panic.
Yeah, I don't even know that I have my whistle handy here. So, but we'll definitely keep our eye on things and report out as we go.
Thank you all. Take care.
Thanks.